Welcome, especially to those of you who've just popped into the room, to what will be the last session of the day.
Oof.
And it is on GP Stakes, private equity's own growth capital trend, a fascinating subject. And to oversee it as moderator, I'm really pleased we have Antoine Drian, founding partner, Mantra Investment Partners.
Thank you very much. Thank you. Welcome, everyone. We will keep this as short as possible, promised, to go to drinks afterwards. But I think we have a fascinating topic, so you should listen as much as you can. We have also a great panel. I will, if that's okay, ask each one of you to say who you are in a minute or two. We just have half an hour, again, including Q&A, so we have to be careful. Tiffany, do you want to start?
Do I need? Oh. Hi, everyone. Tiffany Johnston. I feel like I'm really on the spot here with this light in my eyes. But I am part of the Dial Capital team, which is part of Blue Owl Capital. I've been with the Dial team for about 7.5 years. I spent most of the time that I've been at Dial setting up and then building our value creation team in EMEA. And that's just for a little bit of reference, the team that works with the firms after we buy a stake on a series of strategic projects. It's proven to be a real competitive advantage for us. Several months ago, I was tapped on the shoulder, and I've now shifted over to manage our IR and business development for the EMEA region. Most of you may be aware sort of where Dial fits in the GP stakes universe. We focus on the large end of the spectrum, so buying firmly minority, so usually between 10 and 20% of private market GPs across the spectrum, buyout, VC, credit, real assets, and real estate. We currently oversee about 45 billion in assets. The bulk of that is in our flagship GP stakes funds. We're currently raising and investing the fifth vintage. We also have smaller strategies dedicated to making loans to private market GPs, as well as a small niche strategy JV with the National Basketball Association, where we buy stakes in NBA teams.
Great. Nice to meet everybody. Anthony Maniscalco. I'm the managing partner of InvestCorp's Strategic Capital Group, which is our GP staking platform at InvestCorp. I've been personally involved in GP staking for 15 years. I started as one of the early advisors at Lehman Brothers and then Barclays, where I advised GPs on selling stakes to the likes of Dial and others. And then I transitioned into a principal role at Blackstone in 2012, where I was one of the co-founders of Blackstone's staking business. I was a co-head of the business there and really helped raise that capital and deploy it. And now I've transitioned over time to lead the business at InvestCorp. We're very much focused on the mid-cap space. So we're focused on GPs that manage between 1 and 10 billion across the country, across the world, across private markets, private equity, private credit, real estate, infrastructure. We recently completed our Fund 1, where we raised over 600 million. We manage over 800 million. And we've completed 9 investments in GPs, 5 within buyout, 3 within credit, 1 within real estate, and are actively working with our GPs. Our model is a little bit different. We have operating partners that we've onboarded that work directly with our GPs, helping them with growth, helping them with product development, et cetera. And we also have various channels where we help them raise capital. That's InvestCorp, my story.
And I'm Dominique Gaillard. I'm the newcomer in this fascinating GP stakes world, raising a fund currently of 400 million euros, called Armen. Exactly the same strategy as InvestCorp, but dedicated only to the European market, private equity, private debt, infrastructure, and real estate. And in the mid-cap segment, 1 to 10 billion for most of the portfolio deals that we want to have on our portfolio. And before that, I was for 23 years at Ardian, alongside Dominic Stinky, created Ardian, as you know, has been a big success in Europe. in the world. And I've been for 3 years the president of the French Venture Capital Association, France Invest. So I know a lot of GPs in France.
Well, thank you to you three. Can I start with one very basic question? To me, I'm French, and obviously Dominique is French too. We're in Cannes. I mean, for us, GP stakes is really something that was not so much, trendy here in Europe. I think it's 10, 15 years old in the US. Is there a space in Europe for GP staking? And is size and geographies a limit? Are size and geographies a limit?
Maybe I can start with that, because if we decided to launch Armen today, it's because we think that in Europe, and particularly in France, there is a strong switch from a development of players in the private equity world from a partnership structure, being on one strategy and developing very successfully, raising funds every 4 years and doubling the size of their funds without any need for balance sheet support, to a movement that is much more recent in Europe than it is in the US, where people want to move from mono to multi-strategy, and then it requires cash, either for GP commitments in their own funds, either to seed new strategies and put skin in the games to convince LPs to accompany them, or to make buy and build strategies to move more quickly into more strategies. And 5 years ago, for this buy and build strategy, you couldn't succeed because there was no target to be sold. Now there are a lot of mid-cap players or small-cap players who are overwhelmed by all the parts which are not investments in their workload, and so they prefer to join a bigger player where they will benefit from the infrastructures of these bigger players. So there are companies for sale now, and so that's where they need this buy and build strategy. You need cash to accommodate for that.
Maybe a question for Tiffany or Anthony. What do you have big ambitions here? Is Europe gonna catch up?
Yeah, I can give a little bit of perspective, I think, from the larger end of the market. I think, we see more similarities versus differences between our conversations with US GPs and European GPs. The sort of motivations for wanting to sell a stake to a strategic partner, as Dominique said, are, funding their growth, whether it's, a larger fund, a larger GP commitment, and in many cases, this diversification. And although, the majority of the 40-plus private markets firms that we've partnered with are US headquartered, we have done, a handful of deals with European GPs, Bridgepoint, CVC, Arcmont on the credit side. And I think it's just been a reflection of sort of the depth of the market for that generally 20 billion plus space. There's just been, a sheer volume of more appropriate targets in the US. But I think most of the firms that we partner with now are actually pretty international. So if you pierce through that headquarters, you'll see that I think in our fund we're investing now, of the 14 positions, only one is European headquartered, but the underlying assets are 40% European. And the one other thing I would say that we, at the risk of making a big generalization, we do see some differences in the ownership structure of US GPs versus Europeans. So a lot of the GPs we partner with in the US are, run and largely owned by 2, 3, or 4 of the founders. So if they want to transact, they can do so in a pretty quick and efficient way, whereas several of the European G firms that we speak to have, their roots more in a spin out from an insurance company or a bank, so the equity is more widely held, and in often cases, a senior professional is given equity and then gives it back when they leave. So the decision and the process around selling that stake can just be a bit more complicated and take longer. And I think, one more thing, is what's helpful in our tech is that we've had the same investment team for 10 years. So when these 3, 4, 5-year processes, it's the same investment deal team going and speaking to them.
Yeah, I would just add that you also have to look at the maturation of the industry, in that really on the private market side, it didn't take effect until 2015-16, where it transitioned from hedge funds selling stakes to private markets. And that was initially by the large cap players in the US. And then it started to filter into large cap players in Europe as well as mid cap players in the US. And now we're getting to a point where I think the mid cap players in Europe recognize the benefits of actually having the capital, putting permanent capital on their balance sheet. They're competing for capital with the world, although they may not compete for investments with the world, they're competing for dollars from the world. And so to be competitive, putting capital on their balance sheet is very helpful for that. And so I think it's just part of the trending over time in the industry.
And maybe back to another very basic question, but I guess everyone wants the answer. What's the typical ask by your typical GP?
Well,
what do these guys want apart from money? I mean, that's a clear ask, but what else?
In fact, what we now have been on the market for 4 or 5 months, so pretty recent. In fact, we have a lot of entry call, GPs calling us because they know they will have soon some money. In fact, they require cash for the reason that were mentioned earlier, but they also required our experience in transforming mono-strategy players into multi-strategy players. We made a lot of mistakes at Ardian, certainly, in doing that. And so they say by having us on board, they will avoid to make the same mistakes we did. And on top of that, especially for the mid-cap segments, there are a lot of additional services that we provide. For example, in Armen, we'll have 3 sellers helping the GPs in which we invest to fundraise outside of their comfort zone, which is very often the domestic zone, to have access to, I don't know, Finnish insurance companies or pension funds, Danish family offices. And sometimes the mid-cap players, they don't know how to address them. They don't know how to structure their funds to do so. And so that's where we can bring them some additional services.
Yeah, I would totally agree with that. And at Dial, we have, it's pretty near and dear to me since I spent 7 years building this up, but we have a team of 40 professionals now. We call it the Business Services Platform. And all those 40 people do is work with the 50 plus GPs where we, across, even our old hedge fund investments, where we have a stake on these projects. So, it's completely bespoke. And I think a lot of times we get the question, do these large established firms, care about this? And the answer is yes. We started, when I joined the firm 7 years ago, there were probably 5 or 6 people on this team. It's grown to 40. And I think we support capital raising, but then we also have kind of an in-house McKinsey style team advising firms on projects. So it's, minority and passive, but we try and be strategic. And in some of the areas that we've had a lot of traction with our GPs right now are areas like ESG. A lot of the firms are US headquartered firms who are, in some cases, not as advanced in their ESG journey as some European firms are. So we have 3 people focused on that. We're doing a lot in data science and how sort of analysis of data sets can supplement what our GPs are doing, in their analysis. And the list kind of goes on and on. But
I'll just hit it quickly. So in our part of the market, these are GPs that are younger. They tend to be on fund 3, 4, 5. They really haven't gotten to that scale yet that they want to get to. They're at an inflection point. They're partnering with us because they want access to the capital, but as important is access to advice, access to best practices. What we've done to serve our GPs is we built an operating partner network. So we have right now 5 operating partners that have deep industry knowledge in certain areas. So one of the operating partners is a woman, Barbara Scanlon. She spent 14 years as global head of HR at Oxif. So she works with our GPs on anything human capital related. And she goes in and she sits with the GPs. So she lives with them, she works with them, she helps them with recruiting, she helps with them with the review processes. That's really important to a lot of the firms that are at our stage. Another operating partner, Sarah Kim, she was head of private equity at a group called Iconic, which is the Mark Zuckerberg family office. Before that, she ran private equity or was part of private equity at Stanford. And so she works with our GPs on how do they present themselves to LPs. She's seen thousands of pitches, right? So she goes in, spends a lot of time with them on how do they present their data, how do they present themselves, how do they present their story, and really helps them with that. And so our view is where we can be most effective is really digging deep in the portfolio. We do also have a couple other channels. There's 60 salespeople at InvestCorp. We have access to that group, very strong in certain markets like the Gulf. We, as a firm, own Mercury Capital, which is a placement agent. We have a formal arrangement with them where they make introductions for our GPs to their relationships. So we're really trying to solve both the fundraising side of it, but also the business development, business sustainability piece of it, and be very deep with our GPs.
How do you price a GP?
I'll take that. So we start very much with the DCF. In our part of the market, these are firms where you can do diligence on every portfolio company that they have, look at IC memos, you can talk to the deal teams, and you can come up with a view on what's that portfolio going to get realized at, typically at a discount to what the GP expects, but still you can diligence that. You look at the funds that they have in place. These are forecastable cash flow streams that you have access to. And then in the future, you've got to make some assumptions around duration between fundraises, growth of future fundraise. And you build a really detailed model, and you have discount rates. You stress test it, and you come up with what you think is fair market value. And we're not value buyers. We're not trying to buy things super cheap. We're trying to buy really good assets that are going to grow, that have the ability to outperform our plan by doing new products, doing things that aren't in the plan, but we'll pay fair market value for their current business. And of course, we look at, well, how does that compare to multiples in the market? How does that compare to what private market deals are getting done at? We'll look at also, does it meet our return thresholds? It's great if it's fair market value, but if it's a 10% IRR, that's not going to work. So that's kind of the third check after we do the DCF, the multiples, and the return analysis.
Maybe I could add that we intend to also look at the business plan. It has to be realistic, obviously, but it has also to be quite ambitious, because we know that part of our valuation at exit will be linked to the growth of the AUM. So if a GP from one generation to another increases its funds by 20%, not the same value as it doubles the size of its funds at each generation. So that is also a big part, but it's also DCF, a big part of how we are going to value more one GP than the other.
Yeah, I mean, I would agree with that. We do the same sort of brick by brick cash flow analysis. I guess one thing that we've been asked about a lot recently is has our valuation, our approach changed with what's happening in the public markets? And it really hasn't. I think where, we look at it on a payback basis, but everyone, as Anthony said, likes to talk about multiples. And we've done some work around, how our entry multiples have evolved over time, back from 2014 when we started doing our first PE stakes deals. And they've remained sort of remarkably consistent. And I think that it's more a reflection of the supply-demand dynamics in, the GP stakes, the top end of the market, versus some sort of, set discount to our public peers. And we've just been able to be very consistent, given there aren't as many players in that upper end of the market. So I think Dial has done, of the 22 deals that have been north of 600 million in terms of equity check size, we've done 19 of those, which is, I think allowed us to do that.
Maybe two final questions before we ask the public to ask theirs. Where do you get your money from? And how do you get LP money back to them?
I'll go first. I'll hit it because I think you'll probably have a lot more to talk about. So it's global. Our client base is global. We've spent time around the world. We have investors in Europe. We have investors in the Gulf, in Asia, in the U.S. We have some large insurance companies. The majority of our capital has come from insurance companies. We also have raised a fair amount of money from the ultra high net worth community. So it's broad, it's global. In terms of how we get it back to them, look, I think our model for all of us is going to be similar in that the way we deliver yield is we don't recycle income. So if one of our GPs generates carry, they generate management fee earnings, balance sheet returns, they distribute it to us, we distribute it to our investors, and it creates a very high yield. And that's one of the things that really drives investors to the strategy. Is it's really a private equity-like return profile in terms of MOICs and IRRs, but it comes with a current yield. and that current yield is not 3%. It's somewhere targeted, significantly above that and into the teens. So I think that's where this becomes compelling to investors, is they get their money back very quickly.
Go ahead.
And maybe also, obviously, because of the current yield, a lot of insurers and institutional investors are quite happy with that. The appetite of insurers for infrastructure funds or debt funds because of the current yield. So we have the nature of having this current yield at an increased rate. So that's interesting. The other category that we think are very interested with a GP stake fund are family offices for two reasons. Why? One is that it's rare, especially in this shaky environment, to have the companies in your portfolio whose turnover is made with the management fee of funds that already raised. So that's a visibility on the cash flow, which is not current by the current time. And second, many family offices, when they want to deploy money in private equity every year, they invest in their friends' GP. And so they invest in mostly domestically. In our fund, we're going to invest all over Europe. So we are making extensive due diligence in maybe 15, 20, 30 GPs in 4 years. And then we can bring to our LP base of family offices the capacity to deploy more money with GPs that never heard of. And so we'll give them access to a diversification or their allocation, which is really valuable for them.
Yeah, I think largely from an investor base point of view, we also have an incredibly diversified investor base, both geographically and by type. If I look over the evolution of our funds, how things have potentially changed, I think it's not going to be surprising to anyone. We have seen an increased percentage of our funds from those private wealth channels. It's just a growing area. So I think in our current fund, it's sort of in the 25 to 30%, which is certainly an uptick over past funds. And then in terms of geography, we've probably been increasing the international, proportion of our investor base. And I think yield is the key. So in terms of getting capital back, we actually, our funds are all permanent capital vehicles. So, similar to what the other panelists were saying, we underwrite everything to a really good private equity return from cash flows and loan. So assuming no exits and no terminal value. Of course, there is a lot of terminal value building up over time. So our investment team is looking for ways generally on a portfolio-wide basis to release some of that to our LPs. But I think our investors tend to like the fact that it is, you do have some, really significant embedded downside protection in that share of the management fee income of the GPs, which is really, particularly in this environment, uncorrelated to almost anything else. I mean, it's really sort of exposure to the credit quality of big LPs, like those that are in this room. And then you have the upside of the performance.
And now for your last question on liquidity, I expect my colleagues to buy back the shares of the GPs in which I will enter. So there will be a secondary market, as it is there is probably in the US already. But you can also have family offices or asset managers who are quite happy to be maybe as a passive investors after us, alongside the GP, but happy with the yield return, the yearly return, and happy to see the growth of the assets under management. So that's also an example. But we'll work also on liquidity events at the level of the portfolio, more globally, outside of the sales of the asset that we'll have in our portfolio one by one.
All right. Well, thank you very much. We have 4 minutes, maybe a little bit more. So we will open for questions. Yes, please. Who gives you a mic? You want mine or?
Hi there, thanks. I'm just wondering, I don't know if you saw Peter Till's results this morning, but basically they reported a loss, which is mostly because they raised the discount rate in their calculations. I think what that tells us is that the steady revenues that you get from the management fees are far less valuable now than they used to be, especially when the risk-free rate is going up. And I'm just wondering how much of a problem that is for the industry, for the GP stakes business in particular.
I think you had a technical factor with the discount rates. That doesn't mean there's not cash flows. That's an earnings number. And so I don't want to really comment on their accounting, but that's an accounting number versus the actual cash flows that they're generating. Their also model is different in that they're not required to distribute all the cash flows. The way it's structured is, I think it's roughly 50% of the cash flows they have to distribute. So that's also a benefit you get of being part of a private fund is we're distributing 100% of the cash flows. We're not distributing 50. So we're not holding any back. We're not recycling. We're distributing everything. So I think you have to factor in our DCFs, discount rates going up. That all has to get factored in. But that goes into how you value a business. That's not driving us expecting a lower yield on an investment.
Who's got another question?
Time for cocktails then.
Yeah. It's 6, so if that's it, thank you very much, everyone.
Oh, we got
Can I, on your behalf, thank our 4 speakers in that wonderful session, and indeed thank the other 32 speakers who have been part of this afternoon's session. So thank you to all of them. Can I thank the IPEM team for making things run so smoothly, and for those responsible for this audio quality, which has been excellent throughout. And can I thank you, the audience, particularly if there's any of you who, like me, have been here for the whole 4 hours. We badly need a drink. Thank you very much indeed.